So, hello and good afternoon. I welcome you to today's webinar, hot topic webinar. It's not a trading spotlight webinar as usual, as every Friday, but we have now launched a new series. You probably have seen it on abnormalmarkets.com under the education and there the webinars tab. There's now the hot topic webinar registration page open and today we want to talk about a very, very fascinating topic right now. It's in fact a hot topic, even though there's currently one path which is followed, and I think there's no turnaround anymore, but we will just follow one direction, in fact. It's about central bank stimulus and what this means for our forex trading in general. And also volatility, even though this is something we won't have a look at today. And so I want to guide you here through today's agenda. Let me just have a tick here. Yeah, no, but everything should be fine. So you should now see today's agenda on website here. And yes, so the questions we want to look at today, respectively, we want to answer, and also we want to dig deeper into is when normal monetary policy does not work anymore. We want to have a look at QE, quantitative easing, and its effect on yields, in fact. So quantitative easing has been a topic right now for years. It's just not an experiment anymore, but it's the new normal, we could call it. It's a way to try to stimulate the economy once, as I already said in the first bullet point, once normal monetary policy, yield policy does not work anymore. And in this context, we want to focus on the two biggest central banks in the world right now, on the Fed, the Federal Reserve in the US, and on the ECB. We want to have a look at their balance sheets. We want to have a look at what happened, especially over the last around 12 months. So after the coronavirus pandemic hit, after lockdown was implemented, the global economy, to make long thing short, was nearly completely shut down. We want to focus on Euro USD here, certainly. If we look at the US Central Bank and the European Central Bank, then certainly it makes sense to directly also have a look here at the most affected currency pair. In this case, it's Euro USD. We want to also give an idea on this current, what's taking place. We could call it a race to the bottom. I think that's a fair way to put it. So really a race to the bottom in terms of trying to bring your currency, the value of your currency down to gain an advantage when it comes to export or economic effects. In fact, in this case, then also on the export in this case. And we also want to have a look at the question, what happens if inflation picks up? What happens if real yields drop further? In this context, I just realized that I haven't yet prepared a chart, let's put it that way. So I have prepared several charts, but I just realized right at this moment that there is another chart I came across in the morning. It was just in my let's call it periphery. Yeah, probably that's the right word. So I'm not really sure if I can find it right now, but let me just see. And yes, I have it. Perfect. This is awesome. Beautiful. So I have the chart here, and I will give you a glance at this chart once we reach this slide then. And also what I'm talking about here, and where in this context gold comes into play. So if we talk about forex trading or currencies in general, then we have also have to have a look at gold, because real gold is real money in this case. And in this context, then gold is certainly of high interest, especially when it comes to looking at real yields and current developments here. And in this context, then we also want to give a look at the deeper look at mining stocks in this context. So some of you probably will say, hey, you know what? I want to diversify my portfolio. I want to potentially prepare for an upcoming storm. Probably some of you look at markets and then just think, hey, last week, all the developments around GameStop, for example, all these short squeezes happening right now, and these attacks, which are initiated, let's call it, from retail traders, but then which result in elevated volatility. And I think it's a quite harsh way to put it, but bloodbath. It's probably what probably has happening or happened around GameStop, around Triple BY, around ACM. I'm sorry, AMC, for example, the stock. What happened there wasn't just only retail traders, but it was also hedge funds battling with each other in this context. And probably have had a look at the current pre-market, respectively, developments yesterday. A stock in the yeah, retail industry being quite hot over the period over. Let me just have a look here. Second. Okay, perfect. Yeah, beautiful. The thing is that Tilray, a stock which you probably have heard of, which went parabolic at the end of 2018 and then nearly collapsed to $1 or $2 per stock. Not really sure, but really collapsed 99% nearly during the Corona lockdown and volatility last year, March. This stock has now seen a parabolic move too. It's currently heading up to, let me just have a look here, quick glance, around 60. So we cleared 55 already on the pre-market. So it could be that this is the next potential harsh short squeeze happening right there. So currently definitely a hot stock to look at. And the thing is that this volatility, the pickup in volatility, which we've seen there over the course of the last week, is probably something where we have to say, hey, this is, it was probably just a short, storm is probably the wrong word. Stronger headwinds, we can call it probably, but there's probably something brewing under the surface, which is about to explode. And now the question arises: if you have a long-term portfolio, if you have some stocks which you hold for the longer term, you probably wonder how to prepare for potential storm, which could rise up here. And in this context, we also have to have a look at gold mining stocks as an anti-cyclical asset class in this case, or stock, which you probably should have at least partial within your portfolio. And this is one of the reasons why I want to look at this. So you can see central banks, the current developments here, they do not only have a direct impact on currency pairs like Euro USD, but also on gold, on silver, and thus on precious metals, on the developments around inflation, in this case, real yields, and then thus also have an impact potentially on stocks which are located or which are working within the sector, in this case then in the precious metal sector. So before we start here, a short introduction to my end. My name is Jens. I'm how old am I? 29 plus. I'm not sure. 35. I'm just really have to think about this. Oh, I turned 37 this year, so I'm 36. I really have difficulties with that, but that doesn't matter at this point. So I'm in the financial industry now nearly for 20 years, slightly below that. I started right from school. I went to a bank. I had a traineeship there. And then I found out that trading is what gets me fascinated. And thus I had the privilege in this case to have a girlfriend during that time whose father knew someone who was working as a trader, as a stockbroker, and thus I made my entrance into the world of trading, into the professional, or I started out at a professional trading desk, made markets for equities in this context. And during my studies, I studied mathematics and economics. I then, after short period of time, I really went out on myself, and then also was hired by a broker again here in Berlin, in Germany, and I built their research and education department. And from this, everything developed. And when I was I turned 30 and I was about to become a father, I decided to go out myself and be self-employed. And now I'm working also together with Admiral Markets, one of the, it's not a prime broker, but a leading provider of financial services, especially in the FX and CFD industry. And within this industry now for nearly 20 years, highly competitive offering, especially when it comes to DAX trading. So here in Germany, we refer to Admiral Markets as the so-called DAX expert, but also when it comes to forex trading. So today's topic, I really was surprised, not as much as I should have been probably, but I saw a third-party website and I had a chance to compare spreads and trading commissions between brokers there. And Admiral Markets markets was also on top here. So with the tightest spreads within the industry, and EURUSD, dollar JPY, GBP USD, you name it, and that's also underlining how great of a competitor Admiral Markets is within this industry. So feel free to reach out admiralmarkets.com for further information. Also feel free to contact their customer support directly. They have offices around the globe, 20 offices around the globe. So it's high probability that you will reach out to someone who's also fluent in your native language, which is also very important for most people within the financial service industry. So reach out to Admiral Markets. That's definitely worth your time. And if you're about to open an account, you want to open an account, I think with Admiral Markets, you have definitely a very good choice to be, what's the right word for this? It's not just excited, but it's also that you feel comfortable in this context. So that's it around the introduction. So now let's have a look here at the first question, when normal monetary policy does not work anymore, and we want to have a look at quantitative easing, at QE. That's a short version for that. So it's a form of unconventional monetary policy, and with QE in this context here, we have a technique where central banks buying longer-term securities here from the open market in order to increase the money supply and encourage lending and investment in this case. So that's what's behind quantitative easing in this context. And buying these securities adds new money to the economy by expanding the central bank's balance sheet. This is crucial. This is really crucial in this context. We don't want to dig too deep into quantitative easing, in fact, and overcomplicate things here, but keep in mind, it's the expansion of the balance sheet, which is of interest, especially for us. And also when it comes to looking at the Fed, when it comes to looking at the ECB, when it comes to comparing both balance sheets to each other and how this could influence the currency rate, exchange rate of EURUSD in this context. And when short-term interest rates are either at or drop below zero, which is currently the case, and we are probably about to see the same in the US rather sooner than later, the normal market, the normal open market operations, they target interest rates, so yields in this case are no longer effective, because if yields are at zero, they are at zero. So there's no chance to say, okay, we cut interest rates here and try to stimulate the economy, which is usually the case, which is happening usually in the classic, let's call it Keynesianism in this case. So in this context, if you have interest rates already at zero, there's no further chance to stimulate the economy, given you could certainly, and that's what we get to see, turn interest rates negative, go into negative territory. But the long-term negative effects on such a step are way more damaging to the overall economy, to the overall economic system, than it serves any purpose of stimulating the economy. So right now we have, in fact, a very difficult situation here in Europe in this context, and I will dig deeper into this in a few minutes. But we are probably in a very, very difficult state right now, and this could also add to, or it definitely adds to, the overall skepticism I have around the euro. So also based on that, it's not just right now a hot topic, but it's also worth to think about this, or start to think about this right now, because it could affect the overall developments we get to see in the months to come, in fact. And so once this, normal market or open market operations are not effective anymore, a central bank then can target specified amounts of assets. And so let's have a look here, a clean view on how QE affects yields, what effect do we get to see on yields. So what we have here in white in this case, so this is a screenshot, by the way, from Bloomberg in this case. So what we have here, this is the balance sheet, and we can see this is when the euro started, let's call it, so 1998 and 1999, I'm sorry, and we got the hard currency then here in Germany or in Europe in general. I think it was at the beginning of 2002, so 1st of January, if I'm not mistaken. Was a quite, impressive moment, even though it was more an emotional thing. It wasn't really the knowledge about what could happen then, in fact. So this is something many foresaw, in fact, already 20 years ago, that this overall concept of the euro in this case is a very difficult one and nearly impossible to work out well, play out well. And what we got to see here then was a potential, or it started to increase. The balance sheet expansion started already right from the start of the euro, even though it started to really explode here after the financial crisis hit 2008 with the markets going, let's call it berserk, during the meltdown of Lehman Brothers here, and the whole financial system around the globe being on the brink of disaster due to the massive bets on the real estate market here in the US in this context. So then we saw a period after this massive expansion at the beginning. We saw a period where there was, by the way, let me just have a look here. 2009. Yeah, it was a period. Well, we didn't really see an explosion, let's say, of the balance sheet during that time. I just had to look here because there was now this massive run up. You've seen here that was between 2010 and 2014. I just was a little curious what happened here, but this was the European debt crisis. So that was Greece and Spain and Italy, and the euro debt crisis really becoming a big issue. So that was the financial crisis, so the European debt crisis. And then there was this reduction of the balance sheet here over time span between 2012, I think, till 2015. And from 2015 onwards, we started to really run up the balance sheet. That was the open-ended QE program, which was announced from Mario Draghi. So we already had such a rhetoric, which hit here around 2012. It was, I think, in July, when he was talking about we do whatever it takes, and we were already cutting rates, and we were close to zero, and then we hit zero somewhere here around 2014, if I'm not mistaken. So I really haven't the dates on the agenda, but it doesn't really matter. What we can clearly see is, and this is what this chart is about, the more we expand the balance sheet in this case. So right now we hit a point, let me just see, not really sure, but I think the balance sheet. Oh, okay. So I was a little skeptical. I was just like, wow, didn't we just hit 7 trillion and pushed above that? Yeah, we did, in fact. But this chart here, we can see it. Is till March. No, I'm sorry. June. This is June, April. I think so. Yes. It's June. It's the beginning of June 2015, and we've expanded it even further. So this is in fact just to illustrate what effect QE and the expansion of the balance sheet here has on yields. I was a little irritated because now this number has already passed 7 trillion, in fact, and is about to pass 8 trillion rather sooner or later, depending on how hard the banks are hit by the wave of insolvencies, which will naturally come rather sooner than later. After this lockdown now is extended here in Germany. So this system is about to really collapse, but we will dig into this in a few minutes. So what we see here is that yields, in this case German 10-year yields in this case, are driven further towards zero and even below that. So at the beginning of 2001, 2002, a 10-year US Treasury yield, so-called bunds, they still paid around 5%. And right now we pay something of minus 0.5, I think. So we are in negative territory. So right now, if you give the German government, let's say 1 million, after 10 years, you get back I haven't calculated right now, but you're paying, so you're getting back less than what you gave to the German government in this case. And this is the effect of quantitative easing, because you're driving yield prices, or you're driving yields lower while the asset price itself rises. In this case, so bond futures are rising and continue to rise, while yields drop and drop and drop even further due to the increased demand by the central bank. So this is the effect you should expect once you expand your balance sheet in this case. And the same is also true for the Fed. So what I have here now is I compared the Fed versus the ECB balance sheet. So you can see here the slide before, if you carefully watch, you can see it here, that here, this is a chart from Trading Economics. You can view this yourself, by the way. So tradingeconomics.com, I highly recommend this website. There's tons of fundamental data and also charts you can access here completely for free. And this is the US Central Bank balance sheet. So the Fed's balance sheet in blue. And then we also have in this black line, in this case, it's the ECB balance sheet. And you can see that they're both walking in tandem in this case. So both are rising and rising. And now we can see here also, this is a screenshot I took something like 3 weeks ago, 2 weeks ago, once I prepared this presentation. You can see here the threshold of 7 trillion was passed in both cases. But in case of the euro, it's a big problem. It's a big issue due to the overall gross domestic product, which is slightly below 9 trillion, in fact. And so once you reach a point where the balance sheet surpasses the overall GDP in this case, so in fact, central bank, in this case, the ECB, is printing more euro and liquidating away its problems, let's say, an economic downturn, by just pumping more and more and more liquidity into the system. Once this point is surpassed, where the GDP is less than the balance sheet of the central bank, the trust into the central bank disappears. So you don't trust the money they are giving out anymore, which is one of the big issues in case of the euro, especially if this insolvency rate hits, not insolvency rate, if this insolvency wave hits, and we expect this to happen. So right now, companies are not going down and are still in business only because of laws being how can I say that? So there is no law anymore. So no law on insolvency. And once you have to say, well, I'm bankrupt, I can't pay my bills anymore. So right now, the German government in this case, so this is European wide, but in Germany, I can definitely say that you don't really know whether your business partner can pay your invoice or not. If you go to a company and they say, well, we're still in business, usually if they are insolvent, they have to tell you, okay, guys, I can't pay my invoices anymore. And then they shut down the business. Right now, they are saying, well, if you are affected by the coronavirus, you can stay in business because we expect you to repay your bills and continue to pay your bills after this pandemic is through and we overcome it. Or if done, we don't plan to let you go insolvent because we say, well, there's no law saying so that you have to declare bankruptcy in this case. So and why you might now say, is this really true? You can check the website from the European Banking Authorities. So the EBA in this case, you can Google it, EBA and banks, or respectively insolvency. You see that there is a clear declaration right in March 2020 already that they plan to rewrite the laws, which are right now saying, well, you are not insolvent if your insolvency is due to the coronavirus pandemic. Okay, but I think this is something completely different in this case. What's more of importance is here, we want to now have a look at how the balance sheet expansion in this case affects the currency rate. And what I have here is the Euro USD on a weekly chart. So this is the MetaTrader 5 in this case, and this is the Supreme add-on. You can download this add-on for free on the website from Admiral Markets, by the way. So check out the platforms, and there you have not just the chance to download an MT5 account or demo in this case, but also you can download the add-on in this context. And so what we want to have a look here at is we want to check here the difference between those two balance sheets. So there was already massive QE in the US taking place between 2010 and 2015 or 2014 around. But the QE in Europe, in the Eurozone in this case, started in March 2015. So there was a big difference. So there was massive QE already in the US, and there was not so much QE, or they started shortly after in the European euro. And what we can see here is, if you carefully watch the chart, is back then in 2011, 2012, when this difference was the highest, the euro was still trading here at a level above 130. Oh no, I'm sorry, not 130. I think 150. It was 150. The region around 150, in fact. And so you can see here that once the Euro USD started to really collapse in the afterwards, so there was a massive run lower over the course of the year 2014 already. So they started in March 2015 with their QE program, but they announced it, at least between the lines, already nearly a year earlier, so 9 to 10 months earlier from side of the ECB in this context. And what you can see here is it's the anticipation based on the ECB, respectively Draghi rhetoric, that there will be QE happening, and this expansion of the balance sheet taking place then. And you can see here there was also the reduction of the balance sheet here from the Fed. You probably remember the elevated volatility around the Q4 2018 in this context. The reduction here of the balance sheet, where Powell, the Fed chairman, said that it's now running on autopilot in this context. And this was something which was creating some kind of fear among market participants that the so-called Fed put, so that the Fed will be there once volatility picks up in equity markets, in this case, is not given anymore. And that was what caused massive volatility. And they not just made a 100-degree turn in their rhetoric shortly after, but there was also then some technical issues happening here in the repo market. That was shortly before the coronavirus, the COVID pandemic hit, and then they had to massively expand the balance sheet again by pumping liquidity into the markets to make sure that the whole system is kept alive, and in fact, not just kept afloat, but kept alive. And that is something you can then see here in this context. So the ECB never really stopped, but they break down, or they slowed down a little, let's say, but they massively started to expand the balance sheet again shortly after COVID hit. So you can see, if there is some kind of anticipation or expansion of the balance sheet here, then that this has naturally a negative effect on the underlying currency, in this case, the euro, in fact. So let me just check here the chat box. Okay, perfect. Yeah. Thanks a lot. So you can find the link now to the website for the platform, and also for the add-on on the in the chat box here, by the way. So, and this is what you get to see. So what you expect is right now the central bank, which is more aggressive in expanding her balance sheet, the underlying balance sheet, that should naturally have a negative effect on the underlying currency. The only problem is that both went all in fact. So the Fed and also the ECB. So there's no turning back now. So they really can't stop and turn around, even if the economy picks up. This is something we have seen here. Once they start to decelerate, respectively turn around, try to reduce the balance sheet, you have massive volatility in the markets, because right now this liquidity, which is pumped into the markets from the central banks, is creating some kind of moral hazard. Because what means is, well, you have at least a buyer of last resort, we could call it, and this will be a central bank. If it's the ECB in the Eurozone, if it's the Fed in the US, doesn't really matter. There's a buyer of last resort, and so they naturally will react negative. You get massive volatility and massive sell-offs once this liquidity is taken away. And so we should expect this to continue. The only question is, who's more aggressive in this context? And this is, this is the next slide we want to have a look at here. So the current classic race to the bottom. So currently, the ECB and the Fed are doing whatever it takes and will continue to pump liquidity, continue to do so into the markets, and they won't stop. As I already pointed out, remember what happened in Q4 2018, not 20, I'm sorry, 2018 in this case, when the Fed communicated the reduction of its balance sheet running on autopilot. So massive volatility pickup. And so now the question is, what will be the effect on Euro USD? This is the question we want to answer here. So the effect of the currency, the balance sheet expansion on the currency pair, in this case on the Euro USD. And one side will probably argue that the Fed has further room to push yields lower, and thus the US dollar lower. So have a look at current developments in 10-year US Treasury yields, for example. So they're trading slightly above, but above 1%. So around 160. Let me just check. Where do we have it? Holy cow. So I'm just right now, I'm looking at Tilray. So I have a first minute candle here. So in the high, we were traded at 67. Wow, this is crazy. Okay, so 10-year US Treasury yields, 1.14. So it's 114 basis points. And I have right below that the comparison, 10-year German Bund yields. They're trading at minus 0.45, so slightly below 0.5. That means if we expect the Fed to continue to expand the balance sheet, we should usually expect that there's a higher height from which we will drop 1% and above that, then to the ECB to continue to buy assets, euro-denominated assets, and thus push yields lower into deeper negative territory. So this is naturally something where you say, okay, that means that the US dollar has a higher probability to drop due to yields being relatively high compared to the European counterparts. This is true. This is definitely true, and something I'd confirmed in a natural market environment. But we are not in a natural market environment, but we are now in an environment, and this is my side I'm taking here. I really think that the euro is done. So that sounds quite harsh, but this is exactly what I think. I think we are done. The euro is dead. Right now, it's kept alive. It's like a zombie walking around, but it's dead. Because the thing is, the insolvency here we are about to face, and we already can see that. So everything you can see in the media, everything what's made a topic there, any politician talking to you like a little boy, little girl, and telling you everything will be fine, they are lying. Okay, nothing will be fine. We are done. Okay, so there's so many companies who are already bankrupt, and only they stay in business only because of, hopefully they get some access to liquidity and being kept alive. But so right now, for example, here, there's many businesses in Germany waiting for help to come and the liquidity being handed out to them. I think one of the reasons, even though they tell us, well, that's because of software issues and all that stuff. Well, it's because they don't want to give the money away. They don't want to squander the liquidity in this context, because they know these companies will take the money and then go out of business. If you help them or not doesn't really matter. So to make long things really, really easy in this context, the insolvency wave is something we will face. No matter what, there's no question about that. There will be an insolvency wave, which is naturally here resulting in a bank collapse. European banks are about to collapse because the simple explanation for that is you have a bank handing out a loan to a business, small business, mid-sized business, doesn't really matter. You hand out the loan and you expect the loan to be repaid. Therefore, this small business needs cash flow. If you're not allowed to do business and generate cash flow, you can't repay the debt. So you can't repay the loan, and the European bank, in this case, wherever it might be located, if it's in Germany, if it's in Spain, if it's in Italy, it doesn't matter. Well, the banks just don't get the money back. They hand it out, which means they need someone to rescue them. In this case, the ECB will step up and say, okay, we rescue the banking system. So they are not rescuing any small business out there, but what they will do is they will rescue the banks. The only problem is that They need trillions of euros for doing that. And now have a look at the balance sheet expansion. So what they can certainly do is they can expand their balance sheet further and even further and even further. But the problem is once the balance sheet surpasses a certain point, which is slightly above one in this case, so which is slightly above the current European GDP, then you just don't want to be long in the euro anymore, because the euro has no real value connected to it anymore. Because in this and these are, by the way, numbers. So this is just not a conspiracy theory or something like that. No, but it's something you can. Let me just do it that way. 1 second, please. Let me just get this. You can get these numbers yourself at, for example, Trading Economics. So this is something you can just open here. This is the website, Trading Economics. And what I do now is I look here at the indicators, countries, and then I go to the euro area in this case. The same is also true, by the way, for the US. So don't get me wrong, but the US has another ratio when it comes to the GDP compared to the balance sheet. And I will show you what I'm talking about. So if I have here the GDP, not growth rate, but I want to see, let me just see here. GDP, there we have it. We click here on GDP. You can see that the current GDP, do I have a clear number here? Oh yeah, okay, yeah, it's US dollars. Okay, this is a little difficult because now we have to convert it certainly to euro. We have a euro USD rate of 121, I think. Let me just have a look here. Yeah, 21. So we have 133 through 1.1. Okay, so it's something like, yeah, something around 109.9 billion, a trillion euros. But however you put it, the ratio, and I don't want to dig too deep into details right here, but the ratio we're here looking at is around 67% right now. So the balance sheet compared to the GDP in this context, while in the US it's slightly above 35%. So you have a quite massive gap when it comes to comparison GDP to the balance sheet. In the US GDP compared to the Fed balance sheet, and the EU GDP compared to the ECB balance sheet in this case. And once European banks collapse, which is about to happen, and right now it just didn't happen because they changed laws. This is the only reason why they changed the laws and why this is such a tense situation. You have to pump further trillions of euros into the banking system, expand the balance sheet, and thus then see the GDP being below the balance sheet of the ECB, which will naturally result in a complete market participants losing trust into the euro thus. And this is one of the reasons why I'm very skeptical of the euro. That doesn't mean I want to be all in long USD too, due to the massive expansion of their balance sheet there too. But if I had to take a side now, euro or the USD, I definitely go for the USD due to they have, let's call it, further room to go. Let's put it that way. And right now the picture is quite dark when it comes to the euro in this context. So now the thing is, if I don't want to be long the euro, if I prefer the US dollar, but I'm also skeptical about the US dollar, the question is, which currency do I prefer in this context? And in this context, we want to have a look here at the current developments we see in gold, and also here in 10-year real yields versus gold. So today, by the way, was the day when US inflation numbers were published. Let me just here open another tab and another tab. 1 second, please. So now I wanna open this. Okay. So I hope. So I have quite some resources open here, let's say. So put it that way and that way. So I just hope that now everything opens. So we have first here live squawk. Now we want to have a look at inflation numbers. Inflation came in as expected, 1.4%. So let me just scroll down here. So you can see here CPI is 1.4. Again, 1.5, slightly below expectation as before. 1.5 was expected. So nothing special here. But what's certainly special is this chart from Klatt in this case. It's asset manager in the US, if I'm not mistaken, in the US. It's at least, yeah, LLC. So and what they have here is they have the 5-year real yield, which is rising strongly on the upside, which means inflation expectations are picking up while yields continue to stay low, respectively, are expected to drop further. So real yields should expect to go even more negative in this context. So this is very important here. What they have is they have a real yield in this case inverted. So usually it should drop further, but instead it's rising due to the fact that they're looking at inverted yields in this context. And then they overlaid this chart with gold prices in white. And so you can see there's a quite huge gap. Usually these two numbers are highly positively correlated. So which means that gold has some serious momentum on the upside. And in fact, probably given the developments here we've seen and given the real yields developments we've seen at the beginning of August 2020, when gold hit new all-time highs and pushed to 2075 USD, we have probably even further room to go on the upside. And that said, perfectly illustrates once you have an environment in which central banks are pumping trillions of US dollar and euros into the financial system to keep it afloat, to keep it alive, what you see is a natural demand rising, for example, in this context, in asset classes as gold, as silver, for example. And thus, this is the thing, once inflation picks up, so once the liquidity, and this could happen if market participants are now, let's say, overcoming their fears of an economic downturn, for example, due to the corona lockdown. So if people, if there's coming back to normal, let's call it, coming back to normal in terms of economic growth, for example. So there's a vaccine, we return to a normal. I doubt that, to be honest. So I don't really think that, but this is a scenario which is definitely one which has its fundament, let's put it that way. And that means that inflation could pick up due to that, which could then mean that real yields, due to all the liquidity being pumped into the system from the central banks, ECB, Fed, will naturally drive real yields even lower and lower, and thus make investments in hard assets like gold, precious metals in general, very attractive. And so this is where the real FX trade comes into play, and where an investment here in gold makes definitely sense. So from a fundamental perspective, we're looking at the macro picture here. So don't underestimate the effects we could see on a shorter term time frames. So there can certainly be further pressure on the gold price for several reasons. But it's a price, or you push lower here in paper gold prices in this case. So this is something you really have to understand. We're not really talking about the true, real gold a bar you can put and place in your safe at home or something like that. So we are only looking at paper prices in this context. But also here, there will be certainly a development where you can't really overcome the overall fundamental picture, which is quite dark for our monetary system, respectively quite bright picture you should paint for precious metals like silver. And in this context now, you might probably say, okay, well, great. Okay, I get this. So we have an expansion of the balance sheet. Okay, great. That means that gold is to be favored. The only problem is, now imagine you have a gold bar lying at your home, not paying you any interest or cash flow or something like that, but it's just like, it's beautiful, sure, but it's just lying there and not really working, not really making you richer. Let's put it that way. At least not in real terms, but also only in terms of the underlying currency, US dollar or euro, and you get more and more US dollar for this piece of metal. But the question is now, okay, where can I get an asset which is paying me some kind of interest or yield or dividend in this case? And they're gold mining stocks especially, but also silver mining stocks. So you can really exchange that here if you want. We are now looking at gold mining stocks. This is where gold mining stocks come into play. Gold mining stocks, classic anti-cyclical investments in this context, have been yeah, let's call it underwater for quite some time. So this chart also here from Prescott in this context is showing you gold miners free cash flow yield. So just to explain to you what this is, what is free cash flow yield? It's a financial solvency ratio that compares the free cash flow per share a company is expected to earn against its market value per share. So the ratio is calculated by taking the free cash flow per share divided by the current share price. So that means that the higher the free cash flow yield, the more likely a company is to generate enough cash to easily satisfy its debt and other obligations, including dividend payouts. And why is that of interest? Well, it's of interest because we can go back in history for nearly 25 years now, and we could easily call gold mining stocks in this context capital destroyers. So because this free cash flow yield has been negative nearly throughout 25 years. So there has been a short period here that was around gold hitting its all-time highs back in 2011, around 1,920 USD back then, where this slightly turned positive, but really straight away pushed back into negative territory. And now what you can see here is that this turned positive for the first time, which means that gold mining stocks, which are highly positively correlated to gold prices, but also silver prices, precious metals in general, that they are paying here a positive free cash flow yield for the first time for a quite extended period of time here. You can see it there. Now, since 1995, going back into this area here. And this is something which is of interest for you because companies here like Barrick Gold or Newman Corporation, for example, these companies are paying a dividend, and thus you can get some cash flow generated if you put a small portion of your portfolio into these mining stocks in this context. And that's one of the reasons why I want to make this your topic, because you probably want to wonder, okay, what can I do now in this environment? Because you just formulated a quite, let's call it, drastic view on how you things expect to play out in the next probably months. The collapse of the euro is probably something which will definitely be of higher interest for us all, because things will change if this plays out as I just painted here, the picture I painted. This is definitely something we have to worry about. All of us have to worry about. And so the natural question is, if I still want to be invested in a, let's call it, cash flow generating asset class, what could it be? In this context, I think mining stocks, anti-cyclical stocks in general are definitely something to watch for, to look out for. And that's one of the reasons, or that's the main reason, in fact, why I make here the gold mining stocks a topic. And now let's have a look at the summary. So currently the monetary policy is QE based, and we get to see a so-called race to the bottom. And given the massive expansion of the Fed and ECB balance sheets, it is difficult to spot a macroeconomic advantage for one currency over the other. If you put a gun to my head, let's say, and say, okay, Euro USD, which side do you pick? Well, I could argue one side that Euro USD will rise, and due to US yields have more downside potential than their European counterparts, as shown in terms of the US versus the European yields, German yields in this context. Still, the other side, and this is the side I'd picked in, I'd argue that the euro is done, and an insolvency wave will cause European banks to collapse, leaving the ECB with no other choice than to push the euro over the potential brink of disaster to save them. And that said, my favorite FX trade, since I'm not really favoring the euro over the US dollar, respectively US dollar over the euro, because we have a similar situation, even though some further room, let's say, if we compare GDP in the US to the Fed balance sheet, I'd say my favorite FX trade right now is long gold and silver. Mining stocks also, due to their positive correlation to these asset classes, in this case, and prices of these asset classes. And thus, this is my favorite FX trade in this current environment, in fact. And yeah, that brings us to the end of this webinar. Let me just check before, let me just share here the next webinar taking place on Friday. It's the Trading Spotlight webinar taking place there, which means if you haven't yet registered, you're watching this now on YouTube, feel free to check out atmamarkets.com and check out the educations and there the webinars tab. They can register not just only for the next hot webinar, which is taking place next week on Wednesday with Paul also, but also on Friday. Here we have the Trading Spotlight webinar series where we have evergreen topics, we can call them, and where Paul in this case looks here at the question on how to add to your trade and build a position. So increasing your position size once the market moves in your favor. And this is also including the difference between a trade and a position. Why do we want to add to winning trades, making winning trades bigger, obviously, and how we can actually do it. And Paul will teach you this on the 12th of February, Friday, 2 p.m. London time. Again, if you have already registered for the Trading Spotlight webinar series, check out your inbox for the webinar link. If you haven't yet, then head over to atmamarkets.com to the education tab, click on webinars, and there you can register for Trading Spotlight. And now let me just check it. I just saw that there's another question. How could the effect be for the medical stocks like Fresenius and Fresenius Medical? May it be a hope for an uptrend for gold or Bitcoin? Thank you very much. So these are all also two anti-cyclical stocks. So given that, I'd also prefer the long side. At least part of my portfolio, I could imagine to be placed within these two stocks here, or in the medical sector in general. I think I already made the case for gold or silver. Also, there's a question relating to Bitcoin. That's also a very interesting question right now, especially after Elon Musk announced, or Tesla in this case, announced that they're placing part of their cash reserves in, or plan to do so. Not just did 1.5 billion into Bitcoin, but also plan to continue to do that when it comes to digital currencies in general. So not just focusing only on Bitcoin, but also other cryptocurrencies. It's also that they plan to do that with gold, bullion in this case, but also ETFs like GLD or SLV. This is something they mentioned 2 days ago, so on Monday, if I'm not mistaken. It resulted in a sharp rise in Bitcoin, and we are about to clear 50,000 USD. I really like the overall technology when it comes to blockchain technology. It's fascinating, and I think that our monetary system will be based on some kind of blockchain technology. There's only one problem. I think that Bitcoin as a store of value is very difficult compared to their to gold, for example, or silver in this context. Beside the fact that here we are now looking at gold bars. In fact, I'd like to have my hands on such a gold bar if I have it. If I really I think that the world will come to an end, at least the financial world. I'd like to have something in my hands or in my safe at home, and I don't want to be. Let's say I don't want to be dependent on electricity in this case. So when it comes to Bitcoin, this is one big minus here in this context. Beside the fact that you could easily provide buying stuff with Bitcoins. So I mean, for example, Tesla also announced that they're willing to accept Bitcoin as a way to pay for your Tesla in this case, which is a great step. Now, there's also making rumors rounds that Apple is probably the next to follow here. This is all beautiful. That sounds great. The only problem is, just imagine that a regulator / a government says, well, if you accept Bitcoin as a payment method due to its decentralized structure, well, we force you out of business because you are breaking the law here. We're making the law now which provides accepting Bitcoin as a payment. This is something which you really have to take into account once investing in such asset classes as Bitcoin. Certainly, the same could happen for gold. Happened already several years ago here in Germany during the Third Reich, for example, during National Socialism, for example. It was prohibited for people to have gold, physical gold, and it was you could pay with your head for it, let's say. Okay, so the same is also true in the U.S. There was also a prohibition of gold during the 1930s under Roosevelt, for example. So it's not uncommon that this will happen. But the thing is, you could easily go in your garden and bury your gold, and once the dust has settled, you can go there and take it away from there. This is probably not the case once you look at Bitcoin. So it's very drastic. not really sure whether all this is whether this picture I paint here makes complete sense, but it's definitely something to take into account if you really plan to give Bitcoin a try. It can make sense to have part of your portfolio being invested or having invested in Bitcoin. Still, I'd be really careful about it, not only due to the volatility, but also the long-term prospects here for this asset class. I just hope that this answers the question. So a very fascinating topic. We could easily talk another hour for that. Check out abnermarkets.com for further information. Please feel free to shoot me an email if you're interested in further discussions around this topic. Leave a comment in the chat box below. I just look forward to the next Trading Spotlight webinar then next week on Friday. Next Friday here on the 12th, as I already said, Paul will be here to talk you through how to build a position in trading and increase your potential profits in your trading once the market moves in your direction. All the best. Happy trading. Watch your stops. See you.